In our four-part series of key investing themes for 2021 on Ideas for Profit, today we'll be discussing the Make in India theme, which investors must keep on their radar in the coming year. Make in India theme is a play of two intertwined factors. One is that the current pandemic has accentuated the need for MNCs and sovereigns to de-risk the supply chains. Now, this has led to China plus one strategy of choosing a supplier from a developing country excluding China, and hence Make in India theme throws up opportunities in two different ways. One, wherein exporters which can tap additional global opportunity due to the supply chain shift, and secondly, companies which are focused on import substitution. The second factor which supports this developing theme is the timely intervention of the Government of India in the forms of the series of product link incentives and also protectionist measures that the government has been implementing. Now, outlay for the PLI scheme so far is close to 2 lakh crore rupees, which broadly tends to incentivize incremental production. Under this, investors can keep an eye on the electronics front, as 25% incentive on capital expenditure is for the electronic components or semiconductors, as PLI scheme worth 40,995 crore rupees is for electronic components. Further, in the last 1 year, the custom duties have been increased for 173 items, and the average time taken for the initiation of anti-dumping investigations has now got reduced to 33 days. Now, while the theme is quite broad-based, we do highlight here few of the sectors and the trends that can benefit. Within the chemicals and agri-chemical space and also the pharma company space, most are likely to actually capture the opportunities on this front. These factors have been influenced by a need for reliable supply chain instead of just being a low-cost alternate supplier. Now, sub-segments such as crop production, aromatic chemicals, fluorochemicals and CRAMS are expected to benefit from this theme. Under these sectors, one can look at PI Industries, Bharat Rasayan, Excel Industries, Insecticides India, Balaji Amines, Naveen Fluorine, SRF, NoSil, etc. in the chemicals and agrochemical space. In the pharma space, Ipca Laboratories, Sequence Scientific, Divi's Laboratories, Gland Pharma, Aarti Drugs and Syngene, etc. are the names one can really keep an eye on. Now, in case of the auto ancillary industry, companies are seeing significant opportunity in export markets as the US and the European OEMs have started reducing their dependence on the Chinese manufacturers for component supplies. Now, the likes of Gabriel India, Mahindra CIE, Motherson Sumi, Bharat Forge, also Balkrishna Industries and Endurance Technologies can all be kept on the radar in the coming year. And now, as far as the consumer durables are concerned, though India has lagged behind in terms of global export market share, the recent developments have really got the potential to amplify the share in the export markets in the long term. Now, and finally, talking about the Make in India defense space has actually attracted the highest priority considering its massive size and immediate scope. Now, earlier this year, the government is focused on funding private participation, indigenization and also expedition of projects in the defense sector. Now, as an extension of the same, it later on also has raised the FDI limit from 49% to 74% as well, and also has banned about 101 key products from imports. Now, besides, the government also spoke about setting up of the project management division in order to achieve the time-bound procurement, a nibbling issue which is faced by companies. Now, players like Bharat Electronics, Cochin Shipyard, GRIC, etc. can definitely benefit here. Overall, given the threshold requirement of incentives and capital needed for backward integration and competition from, say, global majors, investors should definitely focus on sector and segment leaders with strong balance sheet to definitely play this theme in the coming year.